Ready to unlock your notary potential and boost your income? It's time to move beyond basic notarizations. In Notary, Niche Navigator by Derrick Spruill, learn the most profitable specialized services. Learn to master high-demand areas like loan signings, international apostilles, and I-9 employment verifications. This essential guide offers new ideas to help you become the go-to expert in your field. Grab your copy of Notary, Niche Navigator by Derrick Spruill today and start building your empire.
So, you buy a car, right? You sit in that tiny freezing glass office, you sign just a mountain of paperwork, shake the dealer's hand, and you drive off the lot.
Yeah, with that little paper temporary tag just like flapping in the wind.
Exactly. And eventually, a few weeks later, your permanent metal plates show up in the mail. From the driver's seat, the whole thing feels incredibly simple.
It really does. You found a vehicle, secured financing, and took possession. Boom, done.
But the illusion of a completed transaction is super powerful there. You have the keys, so you assume the deal is done.
Right, but the physical transfer of the vehicle is entirely divorced from the legal transfer of the asset. The moment your tires hit the pavement, the dealership is actually just starting this highly sensitive, heavily regulated compliance process.
Welcome to Notary Knowledge, everyone. We've got a massive stack of sources today to figure out exactly what happens after you drive away.
Yes, welcome in. And since it is Money Making Monday, we are focusing on how high volume, fast turnaround acts equal steady cash flow.
Oh, absolutely. Steady cash flow is the name of the game. And before we jump into the motor vehicle title niche, just a quick reminder to check out my video podcast, No Notary.
And you can also catch my short form show, 90 Seconds of Notary, for some quick tips.
Yeah, highly recommend checking both of those out. Also, don't forget to grab the Notary Knowledge books by Derrick Spruill. Visit the Notary Knowledge website, and please rate, subscribe, and share the show.
Definitely. So looking at our sources today, we're talking official DMV procedural manuals from California, New York, Texas, plus some B2B industry playbooks.
Right, and internal brochures from these massive automotive titling companies. Our mission here is to uncover this hidden, highly lucrative, and surprisingly complex shadow industry of bulk motor vehicle title transfers.
Because getting that metal plate onto your bumper, it involves million-dollar surety bonds, physical runners wearing county-issued, FBI-cleared ID badges.
It's wild.
It is in a maze of, over 11,000 different tax jurisdictions. It's an entire corporate ecosystem built around an administrative bottleneck.
So to understand why this multi-million-dollar shadow industry even exists, we have to look at the underlying financial mechanics of a car dealership.
Right, because for you, a DMV delay means wasting an afternoon in a waiting room. But for a dealership, a DMV delay is an absolute existential threat to their cash flow.
Yeah, I was looking at the financial metrics in the sources, and the terminology that keeps coming up is contracts in transit, or CIT.
Oh yeah, CIT is everything in this space.
Right, so let's break down the mechanics of that. When you finance a car, you might assume the bank just, wires the money to the dealership the moment you sign the contract.
Which is a logical assumption, but that's not how it works at all.
Yeah.
The bank holds the cash hostage, and for a very good reason.
Yeah.
When a lender finances a $50,000 vehicle, they require legal collateral. The bank needs to see their land perfectly recorded on the vehicle's official state title.
Because that lens is their legal proof that if you stop making your monthly payments, they have the absolute right to repossess the car.
Exactly. Until that lien is perfected by the state's Department of Motor Vehicles, the bank is essentially looking at an unsecured loan. They are not going to release those funds to the dealership until that paperwork is flawless and officially registered.
Wow. Okay. So it's essentially like selling a house, handing over the front door keys, and watching the buyer move all their furniture in, but the bank refuses to give you the buyer's mortgage cash until the city clerk finally gets around to filing the property deed, 40 days later.
That's a perfect analogy. And that 40-day timeline, that is the harsh reality of relying on manual, paper-based workflows.
Because dealerships that still operate by physically mailing title applications or faxing documents, they routinely wait over a month for a completed transfer.
Right. Now multiply that delay across a high-volume dealership selling hundreds of cars a month. They suddenly have millions of dollars in outstanding deal balances just frozen in their contracts and transit ledger.
Which is a massive cash flow nightmare. And meanwhile, they have to pay the interest on their own loans, right?
Dealerships finance their inventory through floor plan credit lines.
Exactly. So the car is gone, the parking space is empty, but because the state hasn't processed the paperwork, the dealer hasn't been paid by the buyer's bank.
So they are still paying daily interest on a vehicle they no longer even possess.
Which creates immense pressure to accelerate the administrative process. And, this pressure has compounded exponentially with the digital retailing boom.
Oh, for sure. We've shifted into this era of borderless commerce, where a customer thinks nothing of buying a truck on their smartphone from a dealer 3 states away.
And just having it delivered right to their driveway. But that geographic spread introduces a terrifying level of complexity for the back office.
Right, because the dealership staff suddenly has to navigate 50 unique state regulations. They aren't just dealing with their local DMV down the street anymore. No, they are dealing with thousands of localized rules. The sources highlight the staggering volume of variables. When a dealer calculates taxes on an out-of-state sale, they're navigating over 50 different variables.
50? That's insane.
Yeah, like, does that specific destination state tax the extended warranty? Do they count manufacturer rebates toward the taxable value of the vehicle?
Or are there county-level transit taxes that need to be applied? And the registration fees have their own separate logic puzzle entirely.
Well, absolutely. The documentation shows over 15 variables just for the metal plate. The fee changes based on the vehicle's curb weight, the number of cylinders in the engine.
Or whether the title is toted as commercial or passenger.
Right, and if a clerk manually types in the wrong fee by even a few dollars, or misses a single middle initial, the destination state's DOV will flat out reject the entire file.
Which, is something we see all the time in our own niche, the sheer cost of human error. It's like when we talk about Hazel in New York messing up the venue on a notarized document.
Yes. Or Nora in Illinois suddenly having to deal with a subpoena because of a clerical oversight.
Exactly. The government doesn't care about your intent. If the form is wrong, it's rejected. Or even when there's intentional fraud, like Luna in Pennsylvania catching a fake ID. The paperwork gets frozen.
Right, and in the dealership world, a rejection means the entire 40-day clock starts over, the paperwork is mailed back, the errors have to be corrected, and the dealership's millions of dollars remain frozen.
I mean, dealerships reached a breaking point where they simply could not afford to rely on their own internal staff to memorize the localized tax codes of 11,000 different U.S. jurisdictions.
Which naturally paved the way for a massive B2B tech ecosystem. Because the dealerships are bleeding time and money, specialized third-party processors emerge to bridge the gap.
To bridge that gap between modern automotive software and ancient mainframe government databases.
Exactly. The playbooks we reviewed focus heavily on companies like automotive titling company ATC and DLR DMV. These companies operate as the translation layer.
Because modern dealerships run their operations on comprehensive dealership management systems, or DMS platforms, right?
Mm-hmm.
We're talking about massive software architectures like CDK Global's Fortellis or Reynolds and Reynolds RCI.
Right. And what these third-party titling processors have done is build complex APIs that integrate directly into the dealership's finance and insurance module.
So instead of a title clerk taking the physical paper deal jacket, looking at the buyer's handwritten application, and manually retyping the name, address, VIN, and loan details into a separate, clunky state DMV portal.
The API just pulls the raw data instantly from the dealership's core software.
Complete elimination of the physical keystroke.
Which is the entire ballgame, because the internal data shows that manual data entry is the overwhelming cause of out-of-state DMV rejections.
Yeah, human error. Typos on a 17-character vehicle identification number, a misspelled street name, or, putting a signature on the wrong line.
Which brings up another notary scenario like Sebastian out in California dealing with a missing spouse signature. It stops the whole deal dead in its tracks.
Or Elias in Arizona getting pressured to backdate a form to save a deal. You just can't do it. But by mapping the raw verified data directly from the DMS into the dynamic PDF logic of the specific destination state, the software auto-populates flawless current forms.
And the speed advantage documented in the sources is striking. While a local manual processor takes an average of 40 days to get the link perfected, these integrated API systems drop the median turnaround time to just 14 days.
14 days. Wow, they are cutting the dealership's frozen cash window by almost 2/3.
Right. Not to mention it ensures you actually get your permanent plates before your 30 temporary tag expires.
Which saves the dealership from a barrage of angry customer phone calls. So it creates a seamless front-end experience by automating the back-end chaos.
Exactly.
But here's where it gets really interesting and where I have some genuine confusion after reading through this.
Okay, what is it?
If the core innovation here is just API integration and autofilling PDFs, why hasn't a scrappy tech startup out of Silicon Valley disrupted this entire industry overnight?
That's a great question.
Right, because mapping data from one software to a standardized form is essentially what tax software has been doing for decades. Why do dealers need these massive, entrenched B2B companies?
Because technology alone cannot disrupt this space. The tech startups hit an absolute brick wall when they realize the states fiercely guard their DMV databases.
Oh, okay.
We aren't looking at a free market where anyone with clean code can just plug in. The states have erected...
But the ultimate filter is the financial requirement.
Oh, yeah.
To operate in California, the provider must secure a $1 million surety bond filed under Form Reg 866.
$1 million? That immediately prices out the garage-based disruptors.
Definitely. But I'm curious about the logic behind that number. Is the state just trying to create an oligopoly for a few big companies? Or is there a functional reason they demand that much financial backing?
It functions as a massive liability shield for the state. When you grant a private company read and write access to a state DMV database, you are handing them the keys to millions of citizens' personal data.
Not to mention the legal ownership records of billions of dollars in assets.
Exactly. If a tech startup has a security breach or their software glitch accidentally deletes 1,000 bank lins, the financial damage is catastrophic.
So the state demands a $1 million bond to ensure that if the private partner causes structural damage, there's a guaranteed pool of capital to draw from.
Right. And California actively incentivizes the dealerships to utilize these heavily vetted BPA partners. The state law strictly dictates what a dealership can charge a customer for document processing.
Right, the document fee limits. If a dealer tries to process the paperwork themselves without using an electronic filing partner, they are legally capped at charging the buyer a $70 documentation fee.
But if they utilize an authorized BPA partner, the state allows them to charge an $85 fee.
Which is fascinating. They are essentially allowing the private market to subsidize the modernization of the state's infrastructure.
Exactly. By letting the dealer pass that slight margin onto the consumer, the state gets the benefit of electronic data transmission without having to build the front-end software themselves.
Well, California's financial barricades are wild, but the physical barricades in New York are on another level entirely.
No, New York is a whole different beast.
Reading the New York procedural manuals felt like reading zoning laws for, hazardous waste facilities. Any entity assisting others for hire and securing vehicle registrations must hold a Private Service Bureau, or PSB, license.
And the spatial regulations tied to that PSB license are just a masterclass in regulatory protectionism. According to their vehicle and traffic law, a private service bureau cannot be located within 1,500 feet of a state or county DMV building in any city with a population over 50,000.
1,500 feet.
Yeah.
And that distance isn't as the crow flies. It is strictly measured by the nearest public street route between the two front doors.
Yes.
So to operate a titling company in New York, it's like trying to open a burger joint. But the law legally mandates you can't be within 3 blocks of a McDonald's, your name can't include the word burger, and your receipts must explicitly state you don't work for Ronald McDonald.
It's a perfect analogy, honestly, because it captures the state's deep fear of brand dilution.
What do you mean by that?
Historically, unauthorized title fixers, or expediters, would physically hover on the sidewalks right outside government DMV buildings. They would intercept frustrated citizens, imply they had official state authority, and charge exorbitant cash fees to cut the line.
So the 1,500-foot rule was designed to physically force the private industry out of the state's immediate orbit.
Exactly. And the naming laws back that up. You have to file a specific form just for name approval, and the state will outright reject any business name containing the acronym DMV or the phrase motor vehicles.
And the mandatory receipt rules also reflect this intense separation. Every single client receipt generated by a private bureau must legally declare in exact wording. This is a licensed private service bureau, but is not an official agent of the Department of Motor Vehicles, State of New York.
Right. Even their digital presence is heavily restricted. If they operate a website, that exact disclaimer must be displayed in at least 24-point bold type on every page discussing registration.
24-point bold type is huge.
It is. They also have to include a notice reminding the customer that they could simply process the transaction themselves for free on the official state website.
The state allows this shadow industry to exist because the sheer volume of dealership transactions would crush the state's internal workforce.
But they regulate the physical and digital identity aggressively to prevent the public from ever confusing a private vendor with the authority of the state.
So if California uses million-dollar bonds and New York uses physical zoning, Texas takes a wildly different approach.
Oh, Texas.
The Texas source material reveals a highly decentralized system that introduces a completely different kind of friction.
Yeah, moving from monolithic states like New York to Texas is like moving from a massive corporate-owned business model to a highly localized franchise model.
Because Texas delegates the actual execution of vehicle titling down to the county level, right?
Exactly. The state creates the overarching framework, but the 254 individual county tax assessor collectors are the ones actually processing the paperwork.
And that creates incredible variance depending on where the car is sold. Under Texas law, any county with a population over 500,000, which obviously captures major hubs like Travis County in Austin or Harris County in Houston, must establish intense local licensing rules.
So a B2B tech company trying to operate statewide isn't just dealing with Austin. They're dealing with the administration buildings of dozens of separate counties.
You had to secure a motor vehicle title service license for the business entity in that specific county.
Right. But the most striking element of the Texas system is how it handles the physical humans doing the legwork.
The runners.
Yes. The document preparers and the physical runners who walk the paperwork into the county offices must obtain an ancillary license.
I was shocked by the security requirements for an ancillary license.
Yeah.
The Travis County manuals show that this isn't just a simple background check.
Not at all.
The dealership or titling company can't just send a new intern to drop out a stack of titles. The runners are subjected to FBI fingerprinting, driving record checks, drug testing, and they must be issued a physical, county-approved photo ID badge.
The intensity of that security check makes sense when you consider the stakes, though.
How so?
Well, in a localized, paper-heavy system, a vehicle title is essentially a bearer instrument for a $50,000 asset. If a runner has nefarious intentions, they are in a position to execute massive title fraud, effectively stealing cars on paper.
Which again brings us back to Luna in Pennsylvania and the fake IDs. The fraud risk in paperwork is massive.
Exactly. The county wants absolute certainty about who is walking into their building with a stack of unperfected liens.
And Harris County even uses the licensing process as leverage for local compliance. The application explicitly forces the owner to declare if they owe any county taxes, local fines, or fees.
Oh yeah, a single unpaid local citation can completely disqualify a multi-million-dollar tech company from conducting business in that county until the debt is cleared.
It's a fascinating juxtaposition. You have billion-dollar dealership management systems routing encrypted data via secure APIs. But at the end of the pipeline in Texas, the whole process still relies on an FBI fingerprinted human runner with a plastic badge standing in line at a county tax office.
It really is wild. And because decentralized paper-reliant systems inherently experience friction, Texas has engineered unique mechanisms for when the paper trail completely disintegrates.
Wait.
The primary example of this is the Texas bonded title process. It addresses the reality of what happens when a title is completely lost, or the documentation is so flawed that continuous ownership simply cannot be proven.
This is one of the most eye-opening scenarios in the stack.
Yeah.
Let's say you buy a used car through a private sale, and before the seller officially signs over the physical title, they just vanish. They ghost you.
It happens more than you'd think.
So you are sitting in your driveway with the physical car, but you have zero legal proof of ownership. In a normal system, you are entirely stuck. You can't register it, you can't get plates, you can't legally drive it. But Texas offers this bonded title workaround.
Because they recognize that freezing an asset indefinitely hurts the local economy. But to obtain a bonded title, the state requires the buyer to purchase a title surety bond.
And the value of that bond is immense.
Yeah, right.
It must be for 1.5 times the vehicle's appraised value.
Yes, 1.5 times the value.
This is where I need to clarify the mechanics. If the seller ghosts me and I have to go out and purchase a surety bond for 1.5 times the car's value, who exactly am I insuring? Am I essentially buying a massive insurance policy to protect the state against my own potential fraud?
Essentially, yes. You are purchasing an indemnity bond, and it protects a wide array of stakeholders. By buying that bond, you are providing a massive financial guarantee backing your claim that you bought the car legitimately.
So it protects the state.
The bond certainly protects the state of Texas from liability for issuing a title without standard proof, but more importantly, it protects any previous owners, unseen lien holders, or even future buyers.
Okay, so if I buy a car, get a bonded title, And 6 months later, a bank steps forward and says, wait, we still hold a lien on that vehicle, or the original owner reports it's stolen. The surety company uses the bond to compensate them.
Precisely. That bond remains active and attached to the vehicle's record for 3 full years.
3 years.
3 full years. During that 36-month window, the title is legally branded as a bonded title, serving as a warning to anyone who interacts with the asset.
Wow.
If someone rightfully claims the car during that time, the bond pays them out. If 3 years pass with no claims, the friction is considered resolved, the bonded brand is dropped, and you are issued a clean, standard title.
It is a brilliant workaround to unfreeze an asset, but it underscores just how much friction exists in the space. The tech providers, the first-line service providers in California, the private service bureaus in New York, they are all essentially massive shock absorbers.
That's a great way to put it.
Right. They absorb the clash between the modern digital retail demand for instant transaction funding and the legacy government's need for strict, methodical, risk-averse paper trails.
They operate as translators. They take the raw speed of digital commerce and methodically translate it into the highly specific, incredibly protective language of local bureaucracy.
And it is a highly lucrative industry precisely because the translation is so difficult. And the cost of getting it wrong, frozen cash flow and expired temp tags, is catastrophic for the dealership.
Absolutely.
The next time you buy a car, take a moment to appreciate the intricate back-end machinery that springs into action behind the scenes. You have API software instantly mapping tax calculations across 11,000 distinct jurisdictions.
You have million-dollar surety bonds posted in California just for the right to ping a server.
Right. You have private service bureaus in New York carefully measuring their physical distance from government buildings.
And you have FBI-cleared runners in Texas carrying your paperwork to the county tax assessor.
They all operating in tandem to ensure that a transaction that took you an hour to complete actually holds up under the rigorous scrutiny of state law.
Which is no small feat.
It really leaves you with a profound question about the future of commerce. As vehicle sales become increasingly borderless and digital, where buying a truck on a smartphone from 3 time zones away is just the norm, how long can a system reliant on fragmented local tax jurisdictions, 1,500-foot zoning rules, and physical human runners survive?
It's a system under immense pressure.
Exactly. At what point does the friction become so great that a single centralized federal titling standard becomes absolutely inevitable? It's definitely something to think about the next time you spot a temporary paper tag on the highway.
A lot of great takeaways today. And listeners, if you have questions about anything we discussed, email your questions to Derrick at derrickspruill.com. We will try to answer as soon as possible at the end of our shows.
Yes, send those in. And before we go, we want to thank our amazing team. Executive producer Derrick Spruill, lead writer Marylyn Trotter, graphics by Eddie Montes Travis, music by Thomas Bynum, and produced by Magnificent Workz Business Solutions.
Don't just be listeners of the knowledge, be doers of the knowledge.
This is Notary Knowledge. Until next time.
Are you truly protected as a notary public? Navigate the complex legal framework with confidence using Notary Law and Liability by Derrick Spruill. This essential guide provides a deep dive into state regulations, ensuring you stay compliant across jurisdictions. Learn how to properly use errors and omissions insurance and master the critical boundaries to strictly avoid the unauthorized practice of law. Protect yourself, your commission, and your business. Get your copy of Notary Law and Liability by Derrick Spruill on Amazon.